This is part 3 of our Chapter 5 video lecture series. This is the last part for Chapter 5. And before we take a look at this rule called law of cost or market, let me illustrate again the cost flow for FIFO, LIFO, and the weighted average method by using this blank screen here. So let's talk about FIFO cost flow. So let's say that I'm in the business of buying apples and reselling them to my customers. I don't buy it by the bushel. I don't buy it by the pound. Here, I'm buying it by the piece, and I'm sticking it into this pipe to store it. Okay, so I'm buying it over here and pushing it through this pipe. And when it reaches the other end, here's what I'm going to sell to my customers. So these are the old apples coming out of this end. And when I buy the newer ones, it's going in from the other end of that pipe. And because of inflation, each time I buy a new apple, it's going to cost me more. So this is the old cheap apples, and here's the more expensive apples on the other end. So what's coming out from the right side is my cost of goods sold apples. Yeah, the older, cheaper costs. And what's coming in here is the newer, more expensive cost because of inflation. Okay, so for the whole period, whatever came out, I'm going to add up the costs, and it's going to be relatively lower because it was bought at the old cheaper costs. And what's left over now here in my pipe, my so-called ending inventory, is going to be at a higher cost. And the physical flow of how I sell apples is pretty much this way. I do want to sell the old ones first before they turn rotten on me, right? And I want to keep at least the latest ones I bought because they're fresher. Yeah, they're going to last longer. So let me illustrate here the opposite of FIFO. And that, of course, is last in, first out. And the container we're going to use to store my apples is a barrel. So every time I buy from my supplier, I'm going to put it here at the bottom of my barrel. Every time I sell apples, I'm going to take it off from the top. Yeah, I'm not going to reach at the bottom. I'm going to take it off the top. So what is being sold is really the newest, latest apples I bought. Yeah, the old ones are here at the bottom of the barrel. Of course, if this was real life, physical flow, this would turn rotten on you. Yeah. So this new cost is relatively high. Again, this is your cost of goods sold, relatively high compared to the FIFO method, yeah, which was relatively a lower cost because you're deducting the older costs. So now at the end of the period, what's left over here in my barrel is the old costs, the cheaper cost because of inflation. That's the cost flow for LIFO, last in, first out. So how would I illustrate this using the average method, the so-called weighted average method? So I'll still use a barrel, but this time I'm not going to sell individual pieces of apples. I'm going to sell applesauce. I'm going to buy apples and mix it up, and here's the level of my applesauce. And I'm going to scoop it out and here sell it to my customers. Yeah. Again, buying apples and mashing it up in my barrel, mixing up new apples with the old applesauce and reselling it. So in here I have a mixture of new and old. So every time I buy more apples and mash it in with what's already there, I gotta figure out a new weighted average. Every time I sell, I'm gonna just use whatever average I have right then and there. I sell some more, I still use that same average. I buy some more. Now I gotta refigure out that average here with the new apples and the applesauce that's already in my barrel. Again, that's the weighted average method. Let's go back to our slideshow and again take a look at this rule called the law of cost or market. The word market is kind of misleading because we're not going to look at the value of how much you can sell your inventory. we're going to use how much it's going to take to replace that inventory you have in stock. So here's the rule again. We're going to adjust the inventory cost amount sitting as an asset at the end of the period, possibly to a lower amount if the replacement cost here called market is lower than the current cost right now. Again, market means replacement costs and not the amount that you can sell it at to your customers. The reason why we're doing this reduction in the value of your inventory is to be something called conservative. Now, we're not talking politics here, yeah, conservatives and liberals. Conservative in terms of accounting means you do not want to overstate your asset, in this case, the inventory asset. We're possibly going to reduce that inventory asset down to its replacement cost if the replacement cost is less than the current original cost you have your assets currently recorded at. In fact, recording assets at cost, recording expenses as cost is one of the principles we learned way back in chapter 1. Now, when we try to calculate this law of cost or market, we can do it in one of three different ways. We can look at the whole company's inventory's costs and compare that amount with the whole replacement value of that same inventory, again, for the whole company. And we just adjust by the difference between the two. Or we can look at different departments, or here they call it categories. So let's say if you're a supermarket, you have a meat department, and you look at all the costs of the meat, and you look at all of the costs to replace that meat, and you pick the lower of the two. Then you move on to the next department. Let's say the produce department. You look at the cost of the produce. You look at the replacement cost of the produce, and you adjust for the lower of the two. Or the more detailed way is to do it by each item you have in stock in the whole store. You look at the cost of your apples, and you look at the replacement cost of your apples, and you reduce it by the lower of the two. Or you look at the cost of the toothpaste you have in your drug department, and how much would it take to replace that toothpaste? Again, you may have to reduce it if that replacement cost is lower than the current cost. And you do that for every single item you have in your store versus just looking at the total cost or the total value replacement cost in your store. So here's an example. In our store, this motorsports retailer, we have only 2 items we're selling. Kind of unrealistic, but it keeps the illustration simple here. Roadsters and sprint models of this item here. And we have 20 units of roadsters, 10 of sprints, and here's the cost we bought them at. If you extend out the units times the cost, you get the total cost for each item. But now at the end of the period, we're going to apply that law of cost or market rule. Again, market means replacement costs. So we asked our supplier, what would it cost us to replace one roadster right now? And they quote us $7,000. Well, that's more than the original cost. So we're going to just keep it at cost right now. Or we ask the supplier, what's the cost of one sprint model? And they say it's market replacement is less, yeah? So we're going to reduce that roadster by $1,500. Or in this case, if you multiply it by 20, here's the total replacement cost compared to the original cost. And we're going to pick the lower of the two. In the case of the sprint, the replacement cost is $6,000, more than the $5,000 cost per unit of the sprint. So what we're going to do is take the total cost and put it here and total up these 2 items. And that's the lower of the cost or market by each item. Yeah. And here you can see the difference is $30,000. So we got to journalize. We got to change our accounts. We got to reduce our inventory asset with a credit. And the offsetting debit is that account we've been dealing with for the past couple of chapters. Yeah, the cost of goods sold. The biggest expense we probably have in our business being increased by $30,000. This is applying the law of cost or market by each item. If you were to apply it to the whole company, in our case, just 2 items, you would probably take a total here total market would be 200,000 compared to the cost of 20. So you reduce it only by 20 if you were doing it this method here. But our company is doing it by per item method. Yeah. Again, this is the concept of reducing your inventory to be conservative by keeping it at its original cost, or if lower, the replacement cost here called market. Let's move on to the next topic, talking about having errors in valuing our inventory and its effect on the current financial statement. That's both the income statement showing profit and the balance sheet showing your financial position, or in this case, the amount of assets you have. This is for both the current period where the error occurs and also any future period. Possibly the error may carry over into the next year or the next period. So taking a look at an example here, this example of 2 or 3 years. So we're at the end of year one, and we go around and count our inventory, and we miscount it. It should be $20,000, but we counted 16. So this is so-called understating your ending inventory, showing too little bit. But the effect is now when you subtract that ending inventory from the goods available for sale, you're going to have a wrong amount of your cost of goods sold. The cost of goods sold is going to be too big. Here they call it overstated because your ending inventory is understated. And because this expense, cost of goods sold, is too big, your gross profit and your net income is too small. Or here they use the word understated. Now, this ending inventory is not only going to affect this year's income statement, it's also going to affect next year's income statement because the ending inventory of one period is going to be the beginning inventory the very next day, the beginning of the next year. And we go through the cost of goods sold calculation, assuming now the ending inventory for the second year is correct and there's no other mistake. This cost of goods sold for the second year is still wrong because we started off with a wrong, understated beginning inventory. So this number here is too small. This is now the second year, yeah? Cost of goods sold is too small because the beginning inventory is understated or too small. And because the cost of goods sold expense is too small, the gross profit and the net income is too big, overstated here in the second year. Okay. And this 20,000 ending inventory, again, assuming it's correct, will now be the beginning inventory for the following year. And assuming there's no other errors in your ending inventory, everything should be correct here. Really at the beginning of the third year, because these are offsetting errors, error here and error here. Same really error, right? The same account, same amount being off. But they kind of cancel out each other. Now, if you take these 2 years together, in other words, this net income plus this net income, both are off. But if you combine them together, you get the correct figure for the 2 years combined. Yeah? Two individual mistakes, 1 year, subsequent year. But if you combine them together, they end up canceling out each other. This is a self-correcting error if you can get by this second year. By the third year, everything should be back to normal. Now we're looking only at the income statement. This also affects your balance sheets because inventory is an asset here at the end of the year, yeah? And well, let's take a look at the next frame here. This is just for year number one. Your inventory is understated, which is an asset. So all of your total assets is going to be understated. And because your net income here is too small, and we learned how we close out expenses and revenues into the equity section, your equity is also going to be too small here at the end of the first year. Now, at the end of the second year, this inventory is correct. This error to net income and this error to net income should now also correct your equity. So the equity, the inventory is correct in year number two, which we don't show in this diagram. It's not overstated or understated. At the end of year two, your inventory is correct. At the end of year two, your equity is correct. In other words, at the very end of year two, everything should be correct if you combine it together from the error from year one. So year three, you're starting off with everything being correct. Again, this is the effect of accounts eventually being deducted through your income statement. In our case, inventory eventually is going to be deducted as cost of goods sold. In the long run, as short as 2 years, everything can be back to normal, hopefully. Let's take a look at the analysis we're given at the end of our chapter 5, figuring out something called inventory turnover and day sales in inventory. So the way we calculate inventory turnover is we look at the cost of goods sold for the whole year and we divide that by the average inventory for the year. That's the beginning of the year plus the ending of the year, and we divide by 2 to get the average. And your answer to this fraction is going to be a turnover rate. And the bigger the number, the better. So the way to visualize this turnover rate, let me do my barrel example. In this case, this barrel represents the store, and you're going to fill up the whole store with inventory all the way to the top here, and you're going to sell the whole thing, and you're going to fill it up again, and you're going to sell the whole thing. This inventory turnover rate is how many store fulls of inventory you sold the whole year. Maybe 5 stores worth, 10 stores worth, more the better. This is really measuring the efficiency of how you're selling your merchandise. Faster the better. It's not telling you how profitable you are. One way to visualize this is that the sales amount or the cost of goods sold amount, a total dollar amount, is the distance you've covered over the year. Probably the bigger the better, right? But this turnover rate is the speed, the speedometer versus the odometer reading. How fast did you get to cover that distance? Again, faster the better. The more efficient you're running the company if you get a bigger turnover rate. Now, the other calculation is how much inventory you have on stock before you run out. So we still use the same 2 figures. Well, really, this is not average, but the ending inventory. And we flip the fraction, we divide now the cost of goods sold into inventory. And if you multiply it by 365 days in a year, because this is cost of goods sold is for the whole year, what your answer is how much days of inventory you have in the store right now here at the end of the year before you run out of merchandise to sell. And of course, you probably want to restock before that happens, yeah? But this is an indicator of how many days of inventory you have left, and you should be trying to keep this down. You probably want to keep this as a small number as possible, but you don't want to be too big, right? Otherwise, you're overstocking. You're using your funds inefficiently. So here's some examples of companies we all know, like Walmart, maybe Costco. Looking at Walmart's turnover, again, how many store fills of inventory they sold during the year, and if you go from past to the current, they're kind of getting better. They're speeding up their turnover rate. They're selling stuff faster. Here, the days inventory kind of steady. In fact, this may be showing some efficiency. You can reduce the amount of inventory you have in your store, and you can invest your funds elsewhere in your business. Yeah. Okay, so that's the 2 ratios we're learning here in chapter 5. Again, make sure you do your smart book problems, do your homework, and then study and take that chapter quiz. From this chapter 5 forward now, we're spending only 1 week per chapter. In prior weeks, in prior chapters, we're spending 2 weeks per chapter. Yeah, so we're speeding things up. In other words, our turnover rate is getting faster here. Okay, I'll talk to you later.